Hi guys, welcome back to the channel. My name is Dave. When it comes to options, I like to keep things pretty simple for the most part. A lot of times I'm selling simple puts to generate some income on stocks that I love. If it falls below my strike price and gets a sign, then I pick up 100 shares of a stock that I like. That's the simple strategy, but there are ways to layer in other option trades with this to get more creative and still add income on the put side. So we're going to talk about one of those strategies today. It's called a put ratio spread, which is a terrible name. We have to come up with something better. But you get the idea. If after you learn the basics of trading options, that is buying and selling puts and calls, those four quadrants, once you can master those, there are some creative ways that you can combine these and come up with something a little bit better, right? That might work better for you in certain instances. And that's the idea of having multi-leg options. So today we're talking about a put ratio spread, which is a terrible name, right? We need something like the iron butterfly or iron condor to define this. It's that great. So I suggest we go back to the 80s in this case. Rodney Dangerfield was in a movie called Back to School. In that movie, he does this incredible athletic feat called the triple Lindy, right? He goes from diving board to diving board. It's just incredible. He's bouncing back and forth, and he finally ends up in the pool. That could be a put ratio spread. We could name it that. We're going to redefine what a put ratio spread is all about while we learn about a put ratio spread. So if that is what you're looking for, please stick around. Whoop. All right, so let's talk about this trade. Let's set one up here on Fidelity. It's simple to walk into and talk about, and it's one of my kind of go-to trades. I really enjoy this type of option trade. I haven't talked about it much, but I do enjoy this type of trade, and you'll kind of see why as we start working through this, I think. So for example, we're going to use NVIDIA, love it or hate it. I'm kind of a NVIDIA bull long term. However, short term, I don't know. But again, when we're selling puts and we're taking in credit, then we should be bullish on that side of the trade long term. So if we end up taking assignment or picking up additional shares long term, we have a long term view. Positive on NVIDIA. That's how this has to begin, I guess, on this side of the trade when you're looking at the stock. So I picked NVIDIA, but some people think it's way overvalued massively. So there's definitely downside to NVIDIA in a lot of people's eyes. So let's set this up. First of all, let's just talk about the normal put. So if you're new to options, I've got plenty of videos that will support selling put options. I'll link one up above if this starts getting out. It starts getting a little bit confusing. But we're going to sell to open one put contract. I picked November 15th. So today's October 11th. That puts us out about 5 weeks. So 1, 2, 3, 4, 5. It puts us just before earnings, but also through the election period, which could add a little bit of volatility. And I'm picking a strike price of 120. So pretty far out of the money, right? 135 to 120, a little over 10% out of the money. So I'm not sure what the delta is. I can probably pull that up, throw it up here if I get to that. But yeah, you're going to collect $241, and this is your basic put. This is kind of my go-to trade. In many situations, I sell lots of puts. And my thought on this is I've got a pile of money here. I invest every week, but I also have this pile of money that I'm trying to activate. It makes about 4.5% sitting there on the sidelines. At the same time, I can sell conservative puts and try to add additional income. Maybe I can get that up to 8 to 12%. Feel pretty good about this little pile of money. Conservative, right? I think that's fair. So in this case, and maybe I'll pick up shares along the way too when we have pullbacks in the market. So anyway, that's selling a put, and instead of limit orders, I like to use puts like this. So if we just go to market, which is great with this, with things like NVIDIA, because the bid and ask are so close because there's high volume and open interest on the option chain, then it's great. It's easy to execute, easy to manipulate, jump in and out of, especially when you have multi-leg contracts, right? So I'm on the hook for this. If it falls below 120, I have to buy $12,000 worth of NVIDIA. So you have to be prepared for that with any kind of option trade. I'm sure you're probably aware. So in this case, we would call this a CSP or cash secured put. Again, if you're new to options, I'm probably covering this stuff too much, but I'm here for that. So anyway, let's do two because I'm greedy. All right. So we're walking into this whole idea. So now we're selling to open two put contracts, November 15th, 120. So I'm on the hook for $24,000 worth of NVIDIA stock because I'd have to buy 200 shares, two contracts at a 120 strike price. Good. So in this case, it's a thumbs up. I got $482 coming to me. And again, down here we have our max gain. That's how much in credit we're taking in. If this expires above 120, we keep all of that. If it falls below, we start to suffer losses, right? We're going to have to close out these contracts and take a loss, or we take assignment of the shares at 120. Right? Again, I've got videos to support a lot of this stuff if you're not following along. We have a max loss of almost 24,000 if NVIDIA goes to zero. It's a bad day for everyone in the market. So I don't think it's going to zero, but stocks have gone to zero, so never say never. But I think we're pretty safe with NVIDIA at this moment. And that gives me a break even of 117.59. Pay attention to that number and how that moves around as we adjust this. So 117.59, that's the 120 strike price minus the credit received divided by 2, right? So 120 minus 241, essentially. Give this 117.59. So that's step 2. You need to be able to do 2 of these. Now you can do 3 or 4 or 5. It is a ratio. I'm not going to hold you to exactly what your ratio wants to be. There are definitions for a put ratio spread that we're talking about here. But our next step is going to be buy to open. So this is going to act as our long leg that's going to be above the current strike price of the sold puts. And it's going to act as kind of an insulator for our trade here and give us lots of flexibility with this option trade. But we're just going to do one because we still want to take in a credit. We're still taking this idea of being a put seller and trying to collect credit on a stock that we are bullish on long term. But maybe through the election we have a significant drop for a few days, and then we can close out this leg, keep the other 2 open, take some profit on that side. Gives you different flexibility as we go through this. So same expiration date, just 1, 2 to 1, and we're going to pick a strike price. Let's start just above that price, so 122. So I guess real quick, if I was to make this 1, this is a debit spread, right? And I'd have a net debit, and it'd be about $45 that it would cost me to put on this debit spread, betting that the stock's going to go down. But we don't want to do that. We want to have a credit. So that's where we get to 2. So we're going to be a net credit. And that credit's going to be right around the midpoint of $200, right? So we're taking in about $500. We're spending about $300. Net credit to us coming into our account, $200. We'll have these options available to manipulate to our advantage, hopefully, as we go through this, if we made this trade. So net credit, 200. Gives me a max gain of 400 and max loss of 11,600. Again, same idea if it goes to zero, except I've got a different credit overall here. And NVIDIA break even is now 116. Okay, so a little bit different feel, right? What was that? Well, about 117.50. We're taking off another $150, getting down to a break even of 116. So what do we hope happens with this particular trade? The max credit that we can receive is if everything heads toward this 120 strike price. If it goes right to 120 at expiration, we're going to have our max gain. Okay. If it goes to zero, NVIDIA goes to zero, we have our max loss. We see our break even is that 116. Again, that's the credit that we're bringing in. Max credit down to 116. Okay. So 120 minus that $400. So that gives us our break even. Now we can play around with this a little bit more and just kind of get a better feel for this, because your strike price that you pick for this long put is going to have a pretty big effect. So we can go to 124 and start opening up the spread here a little bit more, and we're going to see that we then get closer to about 150. We give up a little bit more, but we're going to take in a $150 credit up front. We're going to have a max gain of 550, right? Don't worry about that. But our break even drops down to 114.49 now. Okay, again, start to open up this spread. And this long put starts to cost more and more. We can go higher though. Let's go to 126 and take a look. In this case, it's almost $400. Do we still have credit coming in? Yes, about $93 worth. And that takes our NVIDIA break-even price down to 113. So that's the main effect that we're having here, is as we open this up, we can add more and more to that width between here, plus the credit received, right? So in this case, $600, plus about the $93 that we're getting up credit up front. So you can see the impact of that as you spread this out. So you can be pretty conservative with these, and you can lower your break-even significantly. And you can also adjust this. If you want to do 3 to 1, you can. You can go down to a deeper strike on this side. So it's a very fun trade, and it's one that once you're in and you're used to options, you have the flexibility of closing out that long leg, closing out one short leg, depending on what's going on in the market, or you can close the whole thing out. So I guess based on how you feel about that stock at that time. So there are ways to adjust these as you go through them. So now to illustrate those two trades that we talked about, first let's look at the simple put that we can sell, right? The one that we're used to doing all the time, where we have a price right now right around 135, and we sell a 120 strike price put, and that gives us a break even because we're collecting about $2.50 of 117.50. That would be denoted by the green line. So we want it to stay above this 120 strike price to keep the maximum value of that put, that 250 bucks. And here's our expiration date out to there to 11/15. So we want it above this price by this date. That's a simple put. But how does that compare if we look at the put ratio spread? Going for that maximum width. Again, we're not going to collect nearly as much. We're not going to get 250 bucks up front. We have the potential for a larger gain. So just how does that look compared to this? So if we compare that chart to what we do here with the put ratio spread, we're going to see a significant difference as far as our break-even point, which we're trying to lower in this case. We're taking in less credit initially. Instead of $250, I think it was around $80 or so. But we also have, if NVDA drops down below this strike price above our 126 and ends up somewhere in between here, we continue to add credit all the way down to 120 from that long put. So we have our current price, 135. We have our expiration out till about 11/15. And we have our 120 put that we're selling, two of them. And then we have the single long put that we're buying. So our goal is still to end up as close to 120 as possible to take the maximum credit. But if that doesn't happen, we still keep some credit, about $80. And if it does go crashing down through here, we have more protection because we have a break even that's all the way down to about $113 a share versus $117.50. So I would say this offers more protection, more downside in case something bad was to happen. And then in that case, you have the ability to split apart this trade, right? You've got the put that you were long that you could close for profit. You have two then short legs that you could roll out to a lower strike price, or you could close one with the credit for the long put because it's essentially a put debit spread that you could take out credit now that it's below that strike price, and then you would have one long put that you could roll out to a lower strike price or roll out further into the future, or you could take assignment of those 100 shares. So there's lots of flexibility with this trade, but I just wanted to visually show people how this would affect that price. Now, I've got a couple different live trades that I can show you using this strategy. The first one is with QQQ. They're going out to November 1st. Did this trade back on September 30th. The Qs have been on the rise, so this one's working out in my favor as far as moving away from the sold put side, where I have two of those versus one long put. So you see the one long put here is at 467, stepped down a few points to 463, and that's where I sold two puts. So I had an overall credit with this particular trade. Overall, they've lost about 49%, made 49%. So I'm up 350 here and down 200. So net overall about 150 bucks, 140 bucks. So this one's working in my favor. This is just one example. You can see the cost basis here at the end. So if I was to ride this all the way out to expiration, nothing changed right now with QQQ sitting at 493. I would net out that difference between those two numbers. So that's one example with QQQ. I have another one that I can show you here. So bring in the clone. My second example here is with TLT. That's the iShares 20+ year bond ETF. It's been dropping recently. So I entered this this week, October 7th. Today is October 11th. So it's just a few days old. In this case, I sold 4 contracts at 92. I bought 2 contracts at 93. And it's working against me. So this kind of shows you the opposite side and the effects that it can have. So in this case, I've picked up 94 bucks on this put that I bought, but I'm losing on the puts that I sold as it gets closer to the strike price of 92. But in theory, right, we want it to head right towards 92 and expire there. That's when I would have my max gain at that $92 put. So I think this is a pretty good trade with TLT right now and where it sits. I've been wheeling and dealing with TLT. You've probably seen videos. I'll link that up above as well. You can go watch that. But right now, this is sitting there at a loss. As time starts to tick away, we'll see what happens. So again, just kind of you can kind of see the effects as it drops closer to this $93 put price. But it's also, we're losing value over here. So we'll see what happens as time starts to decay and where TLT goes from here. So yeah, not a whole lot in this particular one, but there's potential if it drops down towards this $92 put price. So those are the basics of a put ratio spread. It's a very effective option trade, something you should check out if you're getting comfortable with trading options. However, if you are brand new, I suggest that you maybe go watch some of these other videos. I'll link some of the basic option trades, those building blocks that you need to really start getting used to trading options. Don't start here, start there, get the basics. Really appreciate you watching. If you have any questions, again, ask down below, and we'll see you next time. Take care. Whoop.